Now today's video, we will be going over exactly how much your rental property should be cash flowing. Now this is really dependent on you yourself and your personal criteria in each property, but my hopes is at the end of this video, you will be able to analyze a property and decide whether it is a good purchase or not based off of the cash flow and the return that you receive from it after purchasing it. What's up everybody? Welcome back to my channel. My name is Evan Phoenix and this channel is all about real estate education and my journey to financial independence through real estate investing. So if that's something that you're interested in, consider going down and subscribing. Now, first off, I just want to point out, if I told you that if you purchased a rental property, you would receive $100 every single month in cash flow. Now you may think to yourself, what the heck, that's not even worth it. That wouldn't even support my monthly Starbucks addiction. Well, I really want you to understand you're not just receiving $100 every single month, you're receiving much, much more. There's three forms of value that you receive with your rental property. The first being the cash flow that we already went over. Let's just say in this instance, you're receiving $100 per month of cash flow on that property. Now, the second source of value is loan pay down. Not only are you receiving $100 per month of cash flow, you're also receiving loan pay down by the tenants, meaning that the tenants are actually paying this property off for you. Now, when you first purchase the property, obviously there's going to be more interest paid off in the beginning than the principal, but the tenants are still paying it off for you. So let's just say in this instance, you're receiving the $100 of cash flow per month and you're receiving $300 of loan pay down every single month. Now, the third form of value is the depreciation that you can actually write off on your taxes. Now, I am not a licensed CPA, so please, any further questions, refer to your CPA. But from what I gathered, most US properties are depreciated at a 3.636% each year for 27 and a half years. And just to note, only the value of the buildings can be depreciated, the land cannot be depreciated. So on a cost basis of a property worth about $100,000 of just the building, that's $3,636 per year and $303 per month. So if you add up the $100 cash flow, you add up the loan pay down of $300, and you include the depreciation of about $303 per month, you get $703 per month that you're actually receiving in value. And that's not even counting appreciation of the property. So I just wanted to go over that just so you have an understanding that you're receiving way more than just the cash flow. Let's get into now what return you want to look at when it comes to the cash flow. Now, my requirement and what I aim for is a 12% cash on cash return when it comes to the cash flow. Now, this is honestly your personal preference and what you feel comfortable with receiving in form of a return on your investment. But since historically the stock market offers a 10% return, a bank CD is less than 2%. With a savings account, you're losing money when you factor in inflation. And to be honest, I don't trust crypto or EFT. So I am extremely happy if I get a 12% cash on cash return. So how do you calculate cash on cash return? So you take the annual net cash flow and you divide it by the total amount of money invested into this project. The total money invested is very easy to calculate, just everything you spent on the property to get it to the point where it cash flow, including purchase, closing costs, renovation. For figuring out the annual net cash flow, you have to break it down to monthly. So what you would do is you would take the income you are receiving on the property, you would subtract the expenses, including the principal, interest, taxes, insurance, property management, lawn care, utilities, water, sewer, trash, anything other that you have to pay for and is your responsibility for the property. So after you take the income, you subtract the expenses, you get the cash flow. But we're not just done there. See, a lot of people just take that number right there and they think to themselves, hey, that is my cash flow and that's it. Well, that's not actually true. What happens if your roof collapsed and you need a new roof and you have a ton of damages to the properties and you don't have the reserves in place to take care of something like that? You could be put in a very hard situation. That's why I take the cash flow and then I subtract again reserves. So I put into account vacancy and repair reserves. Now to calculate that, I put 5% of the monthly income for vacancy and an additional 5% of the monthly income for the repairs on the property. So 10% of the monthly income I'm putting it aside for a rainy day, letting that save up in case of something terrible happening to the property, and then you have the reserves to draw from. Now, after you take the cash flow, you subtract the reserves, you get the net cash flow. You take the net monthly cash flow, you multiply it by 12 months, and then voila, you get the annual cash flow. And the last step, you plug in the annual net cash flow, you divide it by the money invested on the project, and you get your cash on cash return, which once again, I aim for 12%. Let me know down in the comments what you think about my 12% cash on cash return rule that I have for all of my properties. And let me know if you have any other requirements for your properties that you recommend when investing in real estate. If you like this video, I know you guys are gonna love this video.